Good afternoon, everybody, and good morning to folks from Calgary, Edmonton, and Vancouver. Welcome and thank you for joining us today. You all look terrific, by the way. My name is Ram Vidali, and I'm the Global Sector Head for Midstream Energy at DBRS Morningstar. Before we begin, just a few housekeeping items. Please note that you can submit questions using the question and answer box on your screen at any time during the session, and we'll address them at the end. Also, please note that this session is being recorded and will be available for replay on our website subsequently. With that, let's get started. DBRS Morningstar aims to deliver differentiated credit insights across industries to public and private market investors. Our focus today is on the midstream energy industry. The past decade has seen midstream energy companies face numerous headwinds, such as regulatory roadblocks, commodity market volatility, and market access challenges involving social, political, and environmental opposition to pipeline construction. And then came the disruptive overlay of a black swan event like COVID-19. And that continues to linger at this time. And at the same time, the industry is undergoing a transformation in the wake of ESG issues and a transition to renewable forms of energy. TC Energy has been resilient in the face of these challenges, and we are delighted to have with us today Francois Poirier, the new President and CEO of TC Energy, who will share with us his insights on headwinds the industry faces and what the future may hold. Francois joined TC Energy in 2014, following a highly successful 25-year career in investment banking at JP Morgan and Wells Fargo, and to initially take charge of the Energy East pipeline project. In 2016, he successfully executed the acquisition of the Columbia Pipeline Group, a transformational transaction for TC Energy. Francois was appointed as President and CEO of TC Energy last month. And I must say that it was a smooth transition. Francois, congratulations on your new role. We welcome you and thank you for taking the time out of your busy schedule to join us today.
Thank you.
Francois, can I begin by asking you how your life has changed since becoming the CEO, especially as a leader managing through a time of economic uncertainty?
Sure. Thank you for that question, Ram. And as you can see today, I'm working from my home office, so already things are different from what they were a year ago. We provide an essential service in each of Canada, the United States, and Mexico. So we've been very busy ensuring the safety and delivery of our operations in all of those jurisdictions, the safety of our employees, as well as the communities in which we operate. And I'm sure we'll speak a little bit later on about the continued need for safe, reliable, affordable energy, even during the period of time of the pandemic. But with respect to my new role, it wouldn't surprise anyone to know that TC Energy had a very deliberate succession process and also had a very deliberate transition process between Russ Girling and I. Russ has been a friend and mentor of mine for 30 years. And so it's been, from my perspective, a very smooth transition. And my focus, of course, in the near term has been to surround myself with the strongest team in the industry, which I believe we have, with the right capabilities, given some of the challenges that are ahead of us, which I'm sure we'll elaborate on a little bit later on, and setting the right tone at the top around what our vision is and what our values and our culture are going to be going forward. So it's been a good start.
Great. That's a good segue to the next question I have. Is that the long-term impact of COVID on energy supply and demand has yet to unfold, and the bridge could be longer than we thought. I mean, initially. In the current crisis, how do you think about capital allocation decisions such as dividends versus share buybacks, or repaying debt or reducing debt, and also balancing conflicting objectives like maintaining excess liquidity for long periods of time to weather any storm, or to invest in growth? So there's trade-offs to be had. So how do you think about these decisions?
Thanks for that question, Ram. You know, we really work hard to try to abide by the core principles that have led our capital allocation decisions really over the last 20 years. We've maintained a very conservative risk profile and what we call our risk preferences. Typically, we allocate the lion's share of our capital to investments that are underpinned either by regulation or by long-term contracts. And we work to live within our means and reinvest about 60% of our free cash flow into those investment opportunities and return 40% of our cash flow to our shareholders in the form of dividends. And our dividend growth, and while maintaining consistent payout ratios, both on earnings and cash flow of those dividends. So our dividend growth has really been driven by growth in underlying earnings and cash flow. And we have been able to successfully deploy capital over that 20-year period such that we've delivered a 12% total shareholder return on a compound annual basis to our shareholders over the last 20 years. So I think it's been a pretty successful model. It's allowed us to maintain a strong and stable balance sheet. And so balancing all of those considerations, we expect to use a similar model going forward. And share buybacks are, in our opinion, that's the risk-free investment opportunity. So every time we have a significant capital allocation opportunity, we do measure it against the alternative, which is buying back shares. Now, we wouldn't be buying back shares in one quarter and then the next quarter issuing shares. You want to make sure you've got a steady and stable balance sheet with strong credit metrics. But we definitely do have each of our investment opportunities compete with one another as well as compete with buybacks, and that will continue going forward. And as we'll talk about later, the evolution in ESG and otherwise, we're going to have to rethink our capital allocation frameworks, and I'm sure we'll talk about that a little bit later on.
Perfect. Also, staying on the COVID crisis that we have, the weaker global demand and supply fundamentals due to COVID have resulted in increased volume and counterparty risk for pipeline companies. A number of oil and gas counterparties for you, they're rated by DBRS, Morningstar, and others have been downgraded last year. And the trend continues to be negative. So do you see these risks growing, and how does TC Energy address these risks which are out there?
I think there's a really important supporting underlying fundamental is that the basins that we serve namely the Western Canadian Sedimentary Basin and the Appalachian Basin, are both extremely competitive. They're among the lowest cost producers, among the lowest cost to the large demand centers, factoring in all in lifting and transportation costs. And they have tremendous growth potential to respond to changes in demand. So as we look at the energy landscape continentally over the next 20 years, we think those two basins are going to not only survive, but gain market share and prosper. So it's good that we're serving, in our view, the two most competitive basins in North America, and that underpins, I think, credit quality. Contracts are important, long-term commitments are important, but when the underlying resource is competitive, you've got that underlying support as well. So we actually see customer default risk lessening in 2021 versus 2020. Most of our top producer customers are taking a number of proactive measures to live within their means. I think the value creation model for producers historically has been around growing their proven and probable reserves. But now they are reverting more to a living within your means type of model. They've reduced their capital spending and their operating costs. They've divested of non-core assets. To the extent they've been able to, they've opportunistically bought back some of their debt to the extent it was trading at a discount to par. And all of this to achieve positive free cash flow, improve margins, and manage their near-term debt maturities. We've also seen higher natural gas prices, in the second half of 2020 and into 2021, by virtue of some of the reduction in supply from the Permian Basin. So that's done a lot to create a more supportive pricing environment. So we've seen improved access to the capital markets for our producer customers as a result of stronger pricing environment, as well as we've seen them hedging at those improved prices to lock in improved cash flows over time. So in addition to that, as I talked about, the basin being competitive, we deliver to some of the premium markets. Our largest Appalachian shippers continue to have very high utilization rates on our pipeline systems, not just in the United States, but also in Canada. In 2020, we observed average daily receipts on our NGTL system equal to 2019, despite the demand destruction that occurred with COVID. On our US pipelines, we saw a 1% increase in the average volume transported daily on our US pipeline systems, again, despite the demand destruction. And that's because the basins we serve and the markets we serve are attractive markets. So from that perspective, the risk of credit loss is mitigated by our footprint, as well as very supportive regulatory frameworks. So it's something we paid very close attention to in 2020. We expect to pay close attention to it again in 2021. But from a trend standpoint, we do see that default risk improving versus last year.
Great. Thanks for unpacking that for us. The next question is on Keystone XL. What are your next steps on the Keystone XL Odyssey?
Well, it wouldn't be an appropriate conference without asking that question. And thanks for having the discipline to wait until the fourth question before you asked. And I understand. The immediate step, as we announced on January 20th, was to suspend construction of work while we take our time to review the executive order that was issued, by the Biden administration. It's very unfortunate. We've had already over 1,000 layoffs. We've lost the opportunity to put 13,000 North American workers to work this summer by virtue of the president's decision. So it will take some time for us to determine what our next steps are, given the need to balance all of the different considerations, consult with our partners and our stakeholders. We have a government partner in the government of Alberta. We have Indigenous partners in the form of Natural Law Energy that had signed on to partner with us on the project. Of course, we want to preserve, any options long term, but also we're looking at our strategies to recover our capital through legal means or otherwise. The point, though, I want to make is that we remain steadfast in our discipline. TC Energy has been reluctant, given our past history with the project, to put significant amounts of our own shareholder capital at risk. We had a backstop agreement during the development period of the project before FID with some of our shippers, and of course, our partnership agreement with the government of Alberta to take it from FID to progress construction during 2020. So we have to consider all of those. We've indicated that to the extent there is an impairment charge, we'll be assessing that only as part of our first quarter disclosure in the month of early May, actually. So in the interim, we're just assessing all of our options, but we've hit the pause button on construction as we reflect on all of these issues.
Great. A related question is, with the challenges faced to place pipe in the ground, how does the industry and your company look for growth? Will you, because of the challenges, will you consider buying versus building the future?
That's a great question. I think it's fair to say that large-scale mega projects, long linear infrastructure over new right-of-way will be increasingly difficult. However, what that means is that the value of your existing corridors and the assets you have in the ground has just increased. We'll focus on opportunities to invest in our existing corridors. What many people don't realize is that in 2019, we put over $6 billion of projects into service in our existing corridors. And in 2020, we put nearly $6 billion additional of assets into service on our existing corridors. So working on your existing corridors where you have a competitive advantage, you are the incumbent, you know the terrain, projects are smaller, you have strong relationships with the communities, strong relationships with your customers, and also with policymakers. The risk in developing those is much lower than those sort of large mega projects. So I think you'll see us pursuing a larger number of smaller projects in our existing corridors. And frankly, we view that there's a fairly long runway of those types of opportunities to reinvest capital in our existing corridors. With respect to M&A, we've always been very opportunistic in the way we thought about that. In 2003, I believe it was, we acquired the GTN system out of PG&E's bankruptcy. In the late 2000s, we acquired ANR from El Paso Corporation when they were, trying to deleverage their balance sheet. And in 2015, we announced the acquisition of Columbia, not because of any distress around Columbia. It had, in our view, the most attractive backlog of projects in the industry, but they had a significant reliance on external financing in the MLP market to fund their build out. And when that market went away, they were exposed. So our approach to M&A has always been to look for high quality assets at a distressed point in the cycle where perhaps others' balance sheets aren't as strong as ours and we can be more opportunistic, as opposed to acquiring distressed assets and looking to improve their performance going forward. So we don't rely on M&A to meet our growth objectives. The guidance that we've given here is long-term growth of 5 to 7% in dividends. And we don't believe that we'll need to pursue M&A in order to achieve that growth. Any M&A we do would simply, supplement that growth trajectory going forward. Perfect.
Let me pivot, if I can, Francois, to addressing ESG and sustainability, which is top of mind of investors and rating agencies like DBR's Morningstar. We've done a lot of work around that particular subject. Now, TC Energy's 2020 report on sustainability explains how you are analyzing long-term energy market scenarios to assess the resilience of your business. And you're also conducting due diligence to identify potential paths to achieve net zero greenhouse gas emissions by 2050. Now, prior to 2030, your assets are largely insulated from declining fossil fuel demand due to the contracted revenue stream that your company has in place. Can you address the probable scenario where post-2030 we have tougher climate change policies that could materially reduce fossil fuel demand, and what the implications are for your company, and how will you position your assets for the future?
Thank you for that question, Ram. I might challenge you a little bit on the supposition of the demise of fossil fuels beyond 2030, and I'll explain.
Sure.
Every third-party forecast, when they look at energy demand in aggregate, the demographics and the growth of the global population suggests that energy demand will continue to grow between 2020 and 2040, and by most forecasts to the tune of approximately 30 to 40%. So the question is not whether energy demand will grow, is what forms of supply will actually meet that demand. And as we look at that demand growth, we think every form of energy demand needs to play a role. So natural gas will continue to be a fuel of choice out into 2040. We see in North America about a market share of 23% in 2020. We see that growing slightly to 25, 26% in that time frame. But also because the size of the pie is growing, if you will, I think the absolute amount of natural gas demand will grow significantly. We believe oil will also play a role in meeting demand in the future, although we don't see it gaining market share over that time frame. And clearly renewables and other forms and new technologies will increase their share of market going forward. Renewables, we think, will at least double in market share, and with the overall demand growing, the absolute amount of energy supplied by renewables will almost triple over that period of time. And so we need to be part of the energy transition. Our vision is to be the premier energy infrastructure company in North America today, but also in the future, which means that our portfolio of assets will need to evolve over time. I think we'll talk a little bit later about the pace of that evolution. I think it's going to take a couple of decades or more for things to really shift dramatically. And so I think you'll see us continuing to allocate capital to our gas business because we think it'll continue to grow. And increasingly, you'll see us allocating capital to our, first of all, our power and storage business. Secondly, to new technologies like CCUS and hydrogen. And thirdly, electrifying our existing fleet of assets. As you mentioned in our sustainability report, we have some objectives around reducing our greenhouse gas emissions. What's interesting is that about 90% of our compressor stations on our natural gas pipelines are powered by gas turbines. We take gas in kind from the supply that's moved along through our system. 10% of our compressor stations run on electric motors, which are emissionless. So there is an opportunity for us to invest further capital over time in converting our gas turbines on our pipeline system to electric motors. That creates an investment opportunity inside our pipeline business, and also meeting our own electricity consumption requirements by building new renewable generation within our power business. So I think there's just a number of opportunities for us to deploy capital. And frankly, the energy transition, if you have scale, if you have footprint, if you have engineering, regulatory, and commercial experience, will be a huge opportunity for us.
Great. That's definitely reassuring from where we stand. Can I narrow that down? That same premise that you've described. Do you see opportunities to invest in climate change initiatives such as transporting green or blue hydrogen, carbon capture and sequestration, or biodiesel? What are the challenges for you, and what could be your competitive advantages in stepping out from your core businesses into these initiatives?
What's interesting, Ram, is that when you look at hydrogen, for example, it's a gaseous molecule. And what do you need to do well to be an important participant in the hydrogen economy? You need to be able to store gas, transport gas, and burn gas. You know, three things we do all day, every day very well with natural gas instead of hydrogen. So I think our footprint really positions us well to participate as new technologies emerge. For example, in the United States, we are the largest owner of natural gas storage facilities. We have over 3,000 wells, the majority of which are convertible from natural gas to hydrogen storage, and some of them are also convertible to carbon storage. So there's a great opportunity for us there in our footprint. We can also today blend 5 to perhaps up to 10% hydrogen into our natural gas mix in our existing pipelines. Now, there's some very important safety considerations that we need to reassure ourselves of before we go down that path. It's a smaller molecule. It burns invisibly. Its combustion temperature is much lower than natural gas. So we need to be very certain that from a safety standpoint for our employees in the communities in which we operate, that this is, you know, feasible and responsible. And we are also studying different ways to increase the percentage of the blend over time. A gas turbine today that you would purchase today for use over the next 20 or 30 years, for example, could burn up to 40% hydrogen in the blend. So there's definitely potential for that to happen. Now, in order for a hydrogen market or a CCUS market to develop, it needs to be safe, as I mentioned. It also needs to be economical from what I would call an LCOE, or a levelized cost of energy basis. Mm-hmm. And customers and society need to be willing to pay for the increased cost of the equipment replacement. So we're watching all of these, what we call signposts, and those are the signals that will provide us the comfort we need to be thinking about allocating capital in these areas. You mentioned biodiesel. It isn't part of our business model today, but we do actually transport biogas from 6 renewable natural gas facilities, both in the US and Canada. And just, you know, being one of the largest pipeline and storage operators in North America, we think our expertise and our footprint is going to create opportunities for us. It'll require, in my view, quite a bit of time. Regulation needs to catch up to policy and legislation. And then we need to do this transition in a responsible manner. We need to maintain the health of the existing energy system and energy participants, avoid rate shock, and the natural time, for example, to replace a natural gas turbine with an electric motor is at the end of its useful life. So some of those will be in the next few years, but some of them may be 20 years down the road. So there's a gradual path we can do this to maintain the prosperity and the health of the existing energy systems and do the responsible thing and reduce our emissions over time.
Excellent. Let's move from there to the financing side of it. How do you think about using energy transition financing vehicles, such as green bonds to fund green energy projects compared with the traditional financing options currently available to you? How do you see that?
Those are very interesting to us. Our job is to, if you look at that, think about that model where we reinvest 60% of our free cash flow annually and give 40% to our shareholders in the form of dividends. We need to spend $5 or $6 billion a year in new capital to maintain our trajectory in growth of earnings and cash flow. That means we rely heavily on external capital markets to execute our strategy, which is why a strong balance sheet is so important to us. Sustainable finance is a growing and rapidly evolving segment of the market, and we will avail ourselves of those sources of capital to the extent we can check the boxes, we can meet all of the different requirements. There are various products available both in the bank and bond markets that have differing characteristics, and we'll avail ourselves, as I said, of those sources of capital when we qualify.
Perfect. Staying on the same topic, Francois, how do you see the shift in climate policy in the US? And the Canadian policies also are changing in terms of planned increase in the federal carbon tax to $170 a ton by 2030, which is coming up soon. And how do you see these policy shifts impacting your business, and how will you sort of reconcile your business strategy with government policy going forward?
As I said before, people will continue to need energy for decades to come, and that global demand is going to continue to grow. And as I said, the question is, what forms of supply will meet that energy demand? So, our strategy is to prosper regardless of what forms of energy will meet that demand, and government policy will drive a lot of that direction, and it will participate wherever that direction takes us. And so you'll see our portfolio composition evolve over time. In my view, regulation must catch up to policy and legislation for the private sector to allocate capital to it. I talked about our risk preferences earlier. We look to allocate capital where those projects or those investments are underpinned by either regulation or long-term contracts. And right now, there just isn't a clear regulatory framework when your obligation, for example, is to develop projects on the least cost alternative. We are not able to consider the cost of carbon in those decisions under current regulations. I believe either in the United States or Canada. So where we have electric drive motors, for example, on our pipeline systems, it's because the cost of electricity and the capital cost of the electric motors in that individual jurisdiction are the least cost alternative, ignoring putting a price on carbon. But it's very clear going forward that, and we're making capital allocation decisions today, for example, on our 2023 expansion program on our NGTL system, and we would make different decisions if the proposed government of Canada, upward ramping trajectory of carbon taxes gets implemented. We would make different decisions today because the assets we put in place are in service for 40 or 50 years. So we will, going forward, increasingly consider the price of carbon in our capital allocation decisions. And, we are engaged with regulators and our customers in the appropriate forums to make sure that we've got clarity on how we can incorporate a cost of carbon going forward.
Perfect. That's great. Let me pivot to LNG. Given TC Energy's dominant position in natural gas transportation, do you see a role beyond providing pipeline connectivity for LNG exports, such as investing in liquefaction plants and terminal assets? And, to rephrase it, rethink your business model by going beyond the last mile and capture more of the value chain?
That's a great question. Firstly, you're correct that our main focus, in the past several years has been to deepen our relationships and understand the LNG market as a customer of ours. And I think between the projects we have in operation and the projects we have sanctioned, we'll be supplying up to 7 of the major LNG complexes in North America over the next few years. And we're very pleased about the project we made there. But LNG liquefaction and terminal assets could very well be an extension of our infrastructure. As you think about it, liquefaction has made natural gas a global commodity. It used to be a regional commodity, and we need to evolve with it. Some LNG companies' business models are consistent with our risk preferences, where they have tolling agreements or long-term contracts and strong credit-worthy counterparties. And those are the fundamental factors that would attract us to one LNG investment opportunity versus another. Right now, we see enough organic opportunity, as I talked about, in our existing corridors, and with the trajectory our power business is taking, that us investing capital in a very long construction cycle, 5-6 years, that's what it takes to build a large liquefaction plant, is unlikely. But it does fit the risk preferences and would allow us to extend our footprint globally without actually having to leave North America. So it's something that we're constantly monitoring.
That's great. Just a related question to that, Francois. On the LNG export side, can you talk to us if you have any initiatives? You're active on the Coastal GasLink and exports from the West Coast. How about the East Coast? Do you have some thoughts around that, the East Coast and the New England markets? How do you think about those areas?
The Eastern markets are very interesting. They have a significant asset in that many of them are already permitted. We've seen some softness in LNG demand over the course of 2019 and 2020, which pushed out a lot of the FID decisions that we were expecting would be taken in the mid-2020s to perhaps late in the 20s or 2030 or beyond. We are in conversations with many of the East Coast North America developers of liquefaction facilities to provide increased and significant supply of natural gas. None of those have developed to fruition yet, but we are we want to be the supplier of choice to as many liquefaction facilities that are creditworthy as possible. So we'll continue to monitor those. It feels to me like those are closer to the end of the decade in terms of FIDs. As you mentioned, we are the constructor and general partner of the Coastal GasLink project. That in itself has expansion potential. The economies of scale of adding a third and a fourth train for LNG Canada, we would expect are quite compelling for them. And we see the prospect of expanding CGL at some point in the mid-decade to be quite attractive. And the prospects, we're quite encouraged by. So there's a role for Canada to play, an increasing role in supplying the world's natural gas supply, both from the East Coast and the West Coast. I see the West Coast maybe being a bit ahead of the game from a timeline perspective, even beyond LNG Canada, but there are markets to serve from both coasts, and the economics do look quite compelling. So we'd love to be their supplier of choice.
Great. So interesting initiatives on that front. A lot of opportunity there. Just to remind the audience again, you can submit questions at any time now. We have about 5-7 minutes left on the session to the end of the session. So if you can send your questions through the question and answer box on your screens, and we'll address those questions with Francois. I have another question, Francois, for you. And this is more a macro question. Many countries are in the race to achieve net zero GHG emissions by 2050. Do you think conditions are supportive from a regulatory and political standpoint for Canada to be globally competitive in the transition to a green energy economy? How do you look at that situation?
Very much so. I think Canada has all the right ingredients to be globally competitive in the transition. We were one of the first industrialized countries to introduce a carbon tax. We've had a carbon tax in Alberta for large emitters for quite some time. You can see the trajectory of policy from the federal government around wanting to increase that carbon tax, and I think Canada's played a strong leadership role on the international stage there. We have deep expertise along the energy spectrum, billions of dollars of capital invested that can be used and useful as part of the energy transition, and an infrastructure system that can support lower emissions through the development of hydrogen and carbon capture and storage, for example. As I said, ultimately, regulatory certainty and policy predictability are the baseline requirements to attract capital investment, certainly from us and from most of our peers. So in terms of climate change and globally competitive markets, we see a need for market-based policies that promote innovation, but innovation across the full spectrum of potential technologies, so in a technologically neutral manner. Because the important goal to achieve is to achieve greenhouse gas emission reductions. That's the outcome we're looking for. It's not to pick winners and losers among the different technologies. So we would like to see incentives and regulatory support, not only for renewables, but also for hydrogen and CCUS, and create a level playing field and let the market compete and innovate. And as always, as I mentioned before, making sure that we have a healthy energy sector through this transition is what is going to create the wealth and the cash flow for us to reinvest in new forms of energy supply going forward. So I think that needs to be kept in mind as well, Ram.
Perfect. These are great insights, and you unpacked it very well for us, and it's very good now. We will take some questions from the audience, Francois. Some are coming in rapidly here. Let me ask a few that have come in. What is your view on nuclear power in the future energy complex? How do you see nuclear power?
I'm very bullish.
Related to TC Energy and also the industry as a whole.
Yes, very much so. I'm very bullish on nuclear power. I know that the trend in the United States is to be decommissioning nuclear power. The energy density of nuclear is very high. I believe it's something like 2,500 times the energy density of renewables. We're investing $10 billion in the life extension of the Bruce Power reactor units over the course of the next decade. And I think small modular reactors have a very exciting role to play in Canada reaching its net zero goals by 2050. For example, in the oil sands, the steam requirements and energy requirements from oil sands facilities can be met by small modular reactors in an emissionless way and dramatically reduce the carbon footprint of oil sands production. The technology is still evolving. I know that OPG has targeted an SMR at, I believe, Darlington in the commissioning it in 25 or 26, and with an aim to have it in service by the end of the decade. And I know a few other provinces that are in the strategic alliance with Ontario. I think it's Ontario, New Brunswick, Saskatchewan, and now Alberta has joined that alliance. We can expect to see closely on the heels of that FID in the mid-20s, perhaps one or two or three other SMRs. I would love to see a small modular reactor sanctioned in Alberta by the end of the decade, and we are, through our existing cogen facilities, we are the steam and electricity supplier for most of the cogen producers in Alberta. And so we see this as a very exciting opportunity for us longer term.
Great. There's just one more question I can fit in. Maybe we're running out of time, but TC Energy's indigenous community relationships have seen ups and downs. How are you going to ensure that future projects are more acceptable to indigenous communities? I think it's part of the relationship, social relationships that you have.
Thank you for that question. And I'm pleased to be given the opportunity to talk about what we've learned and evolved. And all of us have to evolve in the way we partner with all of our key stakeholders. And part of our culture and part of our achieving our vision is that our goal is to be the trusted partner for all of our key stakeholders. We've offered an equity interest to the First Nations who are along the Coastal GasLink route. That's public information. And what's also public information is we entered into a binding agreement with Natural Law Energy, which is comprised of initially five Canadian First Nations, to invest. They would have invested $1 billion of equity on the Keystone XL project. In our work around reimagining Keystone XL, we talked not only about Indigenous equity involvement, using 100% union labor. We made a net zero commitment, and we also committed to constructing 1,600 megawatts of wind and solar power generation to meet our own electricity supply. So from my perspective, I've seen the energy infrastructure development of the future. You partner with all of your key stakeholders to align economic interests, social objectives, economic benefits for their communities, and that is the way one will successfully develop infrastructure going forward. So we've made tremendous progress in our learnings around equity investment and partnering with First Nations around Coastal GasLink. I mentioned Keystone XL. We're collaborating with First Nations to do the environmental review on our pump storage project in Ontario. So this is the way of the future, and we need to make sure that we have close partnership with our key stakeholders, and that definitely includes Indigenous communities.
That's great. We've come to the end of the session. Francois, we really appreciate hearing your valuable and thoughtful insights on TC Energy and the midstream energy sector as a whole. Thank you so much. And I also want to thank everyone who participated in this conference. And please stay safe. Thank you very much.